Uh, Good morning, everyone, and welcome to Vickery Holman's Property Market Review. For the first time, we are doing this as a virtual presentation, a little bit different to our usual years, whereby we do our 4 office presentations in Truro, Plymouth, Exeter, and Bristol, where we usually use our local office-based people to do the presentations. But this time, we're doing a Southwest commentary in the new circumstances, and we expect to perhaps do another one earlier in the new year as things develop in this unusual world we're in. So today I'm glad to say we've got 4 speakers for you. There'll be Alan Treloar giving you a general update on the commercial property market and the main sectors. Steve Maycock, our development consultancy lead, who will give a talk about the development property and where we are today. And not too surprising, Ollie Steer-Fowler, who's our leisure lead, will be discussing the leisure market. And finally, in terms of presentations, Rebecca Cook, who will give a talk about rating. I know that's slightly off in terms of market review, but we feel it's such an important subject at this time that we will touch upon some of the big changes going on in that area, and significant for so many of our occupiers and our landlords for that matter. During the presentations, there will be polls available, which we hope you'll contribute to for each of the speakers, and also an opportunity to actually do ask some questions in the chat box. Please do put these in. We may not get to go every one of the questions. We're trying to stick to an hour, but we will certainly try to answer as many as we can, and those we can't, we will try to pick up after the presentation. So, and the only other thing I was going to say is I'm delighted that so many of you have been able to join us. It's really good to know that we actually had a slight problem within 2 hours of our publishing our proposed event. We were so full that we actually had to go and see if we could expand the event, and now glad that so many of you have been able to join us, that we've brought a lot more in. So without any further need for me to say much, I don't need to do any fire exit warnings or anything else this time. I can pass on to Alan Treloar, who's going to give the first talk. So Alan, over to you.
Hi Mark, great. Thank you very much indeed for that. Yes, as I say, thanks very much indeed, Mark, and hello everyone from my desk here in the safety of Tier 1. In this update on the commercial property market, I'll give an overview of our experiences over the past few months, some thoughts about the present day, and also look into the future. So many aspects of the market are in the midst of major changes, so much so that we could devote probably a webinar to each sector and probably still not cover all the angles. But I hope this gives a flavour of what we see going on at the moment. We could hardly have picked a more hectic time in terms of the news to hold such an event. When we first started planning it, we were looking at a date earlier in November. And just imagine that, we'd have probably been ahead of the recent demise of some of the major high street occupiers, and also the announcement of a vaccine ready and apparently being released and on its way to the UK. I've moved just to a slide showing some of the faces of our lovely agency team, and as Mark's already mentioned, we provide all of our services from our 4 Vickery Holman office locations. And from an agency point of view, we trade in industrial, office and retail across the southwest. We also deal in development, land and leisure property, but more of that from my colleagues to follow. There will be a poll popping up during my presentation at some stage, which relates to your future relationship with office space. And I hope you'll be able to give your responses to that if it is relevant to how you operate. So looking back, I don't want to look back too far backwards, but what has become clear this year, amongst other things, is that actually the previous year, 2019, was quite challenging from a property business point of view. It seems a distant, far-off world now, but 2019 was heavily disrupted by Brexit and the ups and downs of general election fever, which meant that for significant periods during the year, most people's attention was being distracted, and this meant that the commercial property market was patchy at best. For all but the deepest weeks of the spring lockdown, our agency teams across the region were opening more jobs and showing more people more property, of course suitably distanced, in 2020 than in 2019. So as I've just said, looking back, 2019 actually was quite a difficult year. The first couple of months of 2020 gave us great hope and optimism that the upheaval of 2019 could be put behind us. Things seem to be looking up in a big way. We knew there was a virus elsewhere in the world that might just make it to these shores, but little did we know of the unthinkable speed, aggression and impact that it's ended up having. I'm going to look briefly at our main sectors and share some observations. I'm not going to go into too much detail on deals or specific locations, but if any of you have some specific questions that we can't answer fully in the Q&A at the end, do please let us know and we'll get back to you with a tailored reply after this event. So I'll now go on to reflect on the main property sectors, and I'll start with retail. The high streets had a difficult time for almost as long as any of us can remember, and even though most town centres have ridden out the competition from out-of-town retailing, the popularity of online shopping has been making trading difficult for many years now. The lockdown restrictions have helped further the unrelenting growth of online retail, deepening the woes of many high street retailers who don't perhaps provide something so specific that you can't buy it online, or don't have a certain feel-good factor about what they offer that draws in footfall to their stores. 2019 was all about CVAs in the retail sector, and there's been a continuation of high-profile retailers getting into deeper and deeper difficulties. And of course, one of the most high-profile, the Arcadia Group, is a case in point right now. I'm afraid this was probably coming anyway, as a high street offer from the Arcadia core brands seem to become more and more out of touch with the modern consumer and competition. Of course, this has also now seen a knock-on with Debenhams entering liquidation in the last couple of days. Both these failures were potentially on the cards, but there had previously been hope for Debenhams' rescue, and no doubt COVID has brought about Arcadia's downfall, brought that downfall to a head earlier than might have otherwise been the case. There are going to be changes to what we see on the high street in the years to come. I'll come back to this later. So moving on to the industrial sector, as often is the case, the amount I need to say about the best performing sector is probably shorter and simpler to say than the commentary on retail that I'm going to be just given, and the office sector, which is about to follow. We've seen the industrial sector ride out 2020 very well in the most part. Activities in the sector have generally been much less hard hit in the main, and where they have been hit and empty units appear, demand has been on hand for a mix of occupiers, from self-storage to trade counters, or of course the ever-expanding distribution sector, which is delivering all of that online shopping. Now to just a quick look back at the office sector. In 2020, an office activity has been quite muted in the last 9 months. While retail occupiers have had the incredibly stressful ups and downs of being forced to shut and having to upscale their online offer to generate some income, then cope with reopening only to have to shut once again, and all the investment required to ensure staff and customers are protected and so on. Well, for the office sector, COVID has meant that technology that was creeping into our way of working already anyway, enabling some home working, video conferencing and so on, has just got into overdrive. And the result being that once people found their way around Teams or Zoom, many office occupiers have settled into new ways of working and are now still not even close to having staff back in their premises, as they've been following the work from home when you can, or if you can, instruction. As a result, we haven't seen that much activity in the office sector in 2020, as occupiers haven't known what the new normal is for them. I'll go back to offices a bit later as well. To bring things up to the present, and in the past 4 weeks, unsurprisingly, we saw activity in the second lockdown period dampen, but this has not been as significant a factor as we might have expected. Market activity continued and most deals held together. What we have seen at Vickery Holman, literally in the last couple of weeks, has been that deals that have, in some cases, been in progress for many months, now eventually reaching completion. In fact, November was one of the strongest months for deals completing that we've seen in a long time. It is worth mentioning that deals have taken significantly longer than normal to complete in 2020 in many cases, but not that many have fallen through, in fact surprisingly few. But some of the deals we have been concluding recently, and some we hope will complete in the next few weeks, have been in progress for many months, approaching 12 months in some cases. This month I do expect an even earlier slowdown for Christmas, which is going to frustrate the agents and the vendors amongst us who know that a deal that is completed before the lengthy holiday break is always far safer to have in the bag than a deal that's left adrift for at least a couple of weeks or more over the shutdown. The new year is generally a point in the property cycle when people come back with renewed energy after the holidays and look to make decisions, and we expect 2021 to be no exception, at least in parts, unless a further lockdown dampens and delays things once more. It seems inevitable that in 2021, the Southwest will be popular once again as a destination, just as people get the green light to travel, and the buoyant activity in the Southwest tourism and leisure market has a spin-off for virtually all other sectors. And there'll be more on leisure from Ollie a little bit later on. The impact of whatever the deal is, as far as Brexit's concerned with Europe, will probably impact less on the Southwest than some other parts of the UK, but we've seen before that the way in which Brexit uncertainty and the national mood is affected around this subject and how this impacts on simple business confidence. We only have to look back to 2019 to see that in effect. So back to the sectors, and forgive me for probably speaking longer about retail in particular over the next few minutes. Looking towards 2021 and beyond, when I drafted this only a few days ago, I was going to say that we've not yet really seen the impact on our high streets of the virus, but the failure of Arcadia and now Debenhams, the biggest high street failure since Woolworths almost 12 years ago to the day in 2008, has been brought forward by COVID. It could be that we won't see further fallout until Christmas is over, perhaps not even until furlough ends, and also retailers start having to pay business rates again. We'll have to wait and see whether Christmas and the very recent announcement on vaccines will help us get through the next few weeks and into the spring. Factors may still conspire and lead to further retailers coming to the end of the road, however, and who knows quite how many more larger prime located units in particular we'll see empty when the Arcadia situation works itself through, adding to the other large prime units already vacated by other household names such as Debenhams, M&Co, Edinburgh Woolen Mills, Peacocks and many more, even before the events of the last few days. It may take some time, but in due course I can see there being demand for smaller retail stock once more in perhaps off-prime city locations and market towns as existing occupiers relocate, perhaps taking advantage of cheaper deals on better located premises, and individuals look at startups or cautiously adding units to growing businesses, which are successful and can beat the online competition. Other users are also looking at retail space as an alternative to the less high-profile space they might have once occupied. There's a trend for offices and consultancies coming down to the high street in market towns, in particular for greater prominence and approachability to their clientele when they were once almost always found in offices above shops. Owners and investors will also be looking in earnest at the prospects for conversion and redevelopment to residential, for instance, and generally to repurpose space which is otherwise what could be quite difficult to re-let. I do personally have faith that many people do want to be part of a busy town centre experience once again as a place to socialise and at the same time enjoy the experience of shopping, but locations are going to have to make themselves even more visitor friendly, and this may need even greater intervention and innovation from all the stakeholders concerned, from occupiers through landlords, local bids, councils and even the government. There are other areas of hope for retail. As I've said already, people want to be social and visit attractive places. So popular destinations that people gravitate towards for a positive experience are going to recover best. And in the southwest, we're spoilt with towns which are either coastal or country or have some other USP that keeps people coming back. Food and other essential shopping remains a necessity, and we're seeing a resurgence of demand for smaller convenience stores in roadside and neighbourhood locations, bringing the provision of food shopping closer and closer to the consumer. The drive towards repurposing of the high street and the blurring of several previously distinct retail and other property uses under the old planning use classes order to a new wide-ranging use class known as Class E will help make this transition to other uses in retail space take place. The most difficult properties to repurpose are going to be the large purpose-built high street units, which by their very nature are cavernous in some instances, with perhaps natural light only from the shop front and sometimes no easy conversion to other uses. Some of this larger space may be taken up by other retailers, and perhaps the gym sector, for instance, might return, though most are represented in most towns now, and they will be looking for ultra-competitive terms. We've also seen a demand in some locations for new requirements that have come about as a result of the pandemic that can be well suited to larger retail space, and we'll see how that unfolds in the months ahead. Retail rents were under significant downward pressure even before COVID, and now it's not unusual, even in previously well-regarded high streets, to see rents in some cases reduced to levels of only half where they were only a few years previously. We're also seeing an increasing number of proposals for at least part of a rental package being linked to turnover. So retail deals are not going to be easy in the period ahead as tenants take advantage where they can. As an example, I've recently been involved in letting a very well-located shop in a popular town, which has just been let for around half of what the previous occupier was paying before that previous occupier went into a CVA and effectively left that unit 18 months earlier. One thing that is for sure is that we must all make a contribution to support our bricks and mortar retailers, if we are able to do so in a safe way, of course. And I hope that we'll all be doing our best to shop local, as the immediate future of our town centres depends on it. So just turning briefly to industrial. The industrial warehouse and distribution sector looks set to generally power on through 2020, though older stock is going to get further left behind as occupiers' requirements for better quality and more efficient premises continues to evolve. It is worth having regard to the fact that current consultation is underway, led by the government, which states that the preferred trajectory for non-domestic property which is let is to have a minimum EPC rating of B by 2030. Which 2030 is not as far away as it sounds, and compare that rating of B to the rating of E, which is the minimum for letting purposes at present. But EPCs aside, the logistics and trade counter subsectors in particular are going to continue to be the most active areas. I don't see rents or prices coming under negative pressure, apart from the poorer stock losing ground perhaps. Briefly moving on to offices. The office sector will see occupiers in 2021 begin to formulate their plans for the new look future and beyond. And as such, we will see a return of inquiries for office space as occupiers begin to see past the present and assess just how they think they will operate and reflect on how efficient they have or haven't been with so much home working having gone on in the COVID period. I can see this meaning that some occupiers might end up in the same space but with fewer staff in the office at any one time, which is perhaps what some of us are already doing, while other occupiers may look at trimming the office costs by renegotiating terms with their landlords to take a smaller footprint, potentially linking this to their next lease renewal or other event. I have been hearing the odd story of office occupiers seriously considering moving to a completely home-based regime, but I do think and hope this will be the exception rather than the rule, as most people will still crave the interaction and support that can be gained by at least some regular office-based contact. This may all mean a reduction in the amount of office space required by individual occupiers, but we must remember that the available office stock has been reduced in recent years with the conversion of a good deal, or quite good quality in some cases, office space in town and city centres to residential use under permitted development rights. So we might see some more space coming onto the market, but perhaps it won't be quite as noticeable as if we saw the same scale of accommodation in the market as we did before those permitted development rights came in 2013. How we use offices adapts, and how that goes forward. We may see rents under pressure as occupiers perceive their position to negotiate strengthening, but this will become clearer as 2021 unfolds and the new future of the office develops. Due to this uncertainty, some occupiers may seek flexible terms to ensure they remain as agile as they possibly can if their needs change, rather than being tied into longer leases. And so to conclude, time hasn't really allowed me to go into regional statistics and trends, but I think, as Mark mentioned at the start, we'll be able to have further webinars in the spring where we'll go into more detail of specific market activity. We'll also pick up the investment sector then as well. But for now, I'm very, very grateful for your attention. I'd like to leave you with a call to do your bit in the run-up to Christmas if you can, and shop local. And finally, if I'm able to see the poll results somewhere, I'm not sure if I can. My question was around how you thought you'd be operating going forward over the next year, and let's have a look at the results. So the majority, perhaps unsurprisingly, obviously I haven't had time to look at this properly, let's have a look here. Yeah, so we've got a large number, 65%, who are looking at a mix of home and office space working for next year. And actually we've got 25% of people as well, largely thinking they're going to be home-based irrespective of restrictions next year. So maybe the challenges for the office space are perhaps even more pointed than I'm hoping they might be, with only 10% mainly think they'll be mainly office-based. But that mix of 65% in the middle are going to have a mix of home and office space working. They're still going to need that office to come to in their respective towns and cities. So it's going to be interesting to see how that unfolds. And thank you very much to the 120 of you who responded. I'm really, really grateful. Thank you. So now I'd like to hand over to my colleague Steve Maycock, who will give us an update on the development sector. Over to you, Steve. Thank you.
Thank you, Alan, and good morning, everyone. So yes, as Alan mentioned, my name is Stephen Maycock. I'm a chartered surveyor and I head up the development consultancy team here at Vickery Holman. My presentation this morning is intended as a general market update, so looking at the housing market, delivery, land, and also some of the proposed planning reforms currently being considered. So just before I get into that, if you'd like to respond to the poll that will appear on the right-hand side of your screen in just a moment, then we can pick up the responses towards the end. And the question I'm putting to you is, in the next 12 months, will average house prices in the Southwest go up, down, or will they stagnate? So COVID-19 has clearly had an impact on the housing market over the past 9 to 12 months, although perhaps not in the way it was first envisaged. I'm sure that many of you will have seen the rather grim reports that emerged in late March and April of this year, where many of the experts and commentators were predicting that house prices could fall by up to 5 to 10% in the short term, with these predictions largely underpinned by the prospects of falling incomes, unemployment, limited availability of mortgage products, and of course, high levels of uncertainty more generally. But fast forward to October of this year, and Rightmove have just recorded a new national record for the average price of property coming to the market, with prices around 5.5% higher than a year ago, which is actually the biggest rate of increase for over 4 years. What the data also shows is that prices in the Southwest are increasing at a quicker rate than any other region, and I'll touch on the likely reason for this shortly. Activity levels also hit new records, with the highest number of sales ever agreed being reported in September. That's up 70% on the same month last year. Likewise, mortgage approvals in the month of September climbed to their highest level since 2007. Whilst there was some initial uncertainty leading into the second lockdown, with the news that the housing market would remain open, buyers quickly jumped back into action. The question now really is, how long is this mini boom likely to last? We know that a number of factors have been helping prop up the market since it reopened. This includes obviously the pent-up demand built up over the first lockdown, low interest rates, and of course government intervention, namely the stamp duty holiday, which has clearly been a major contributing factor. There are now some early indications that this momentum is just beginning to ease off. Last month, Rightmove reported that asking prices retracted by 0.5% compared with October, which could be a result of new sellers pricing more realistically to have a better chance of agreeing a sale in time to benefit from the stamp duty savings on their onward purchase. Although the outlook going forward does remain pretty uncertain. We predict that activity is likely to slow in the short term as the government's financial support schemes and stamp duty cut come to an end in the spring next year, if indeed they do. Are we likely to see a housing market crash or a major price correction? No one can be sure of what the future holds, though historically rises in unemployment have resulted in falling house prices. So we must wait to see the true impact that the pandemic has had on the labour market once the support schemes come to an end in March next year as planned. What I would say is that it's probably unlikely that the housing market will continue to remain immune to the impact of the pandemic. So some form of downward pressure on house prices nationally should probably be expected at some point in the months ahead. But I think with the current high levels of demand, the impact in places like the West Country may well be largely unfelt. I'm certainly remaining pretty optimistic about the prospects for the Southwest. And I mentioned demand, and really this shifting of demand has been another change to have come about as a result of the lockdown, particularly for rural and coastal properties in the Southwest, as people have realised that they can now work remotely in what they see as a healthier environment. And then this is no doubt driving a lot of the house price growth that we're seeing in the region. Of course, wherever there is change, usually comes opportunity. And this is true in this case, as we see some developers moving to get ahead of the curve in terms of thinking through what we are building for the new future, with the ability to work from home with good digital connectivity and outdoor amenity space, all becoming high priority requirements. As ever, our advice to landowners and developers when considering what to build is seek advice early. The last thing you want to do is pursue a suboptimal scheme that doesn't realise best value from the land. In terms of housing delivery, ONS statistics show that new build starts in the period from April to June 2020 were down 52% compared to the previous quarter, with new build completions in the same period down 62%, again compared to the previous quarter. This is unsurprising given the stringent lockdown measures that were in place during that quarter, but nonetheless demonstrate the impact that the measures are going to have on delivery this year. We should get the data for the third quarter shortly, which we anticipate will show a significant increase, But over the course of 2020, some analysis is now showing that we could see as many as 85,000 fewer homes delivered this year compared with 2019. After the initial shock of lockdown, construction work did recommence pretty quickly once the measures were lifted. However, as productivity declined, most programs have experienced delays. This, of course, has been in part due to the closure of building sites and the need for social distancing measures that followed, but also blockages in the supply chains and delays in the planning system, which has struggled to cope as officers have been reassigned to more critical tasks. The extended programs has, in many cases, resulted in cash flow issues, especially for SME developers, some of who have unfortunately failed to survive. A survey recently carried out by the Home Builders Federation showed that almost half of SME house builders have said that their growth projections are down by up to 50% due to COVID-19. The survey also revealed that planning continues to be a particular concern when it comes to industry growth and delivery, with 83% of respondents citing delays in securing planning permission or the discharging of planning conditions as being a major barrier to increasing housing delivery over the next 12 months. And these planning setbacks, of course, disproportionately affect SMEs, as they often have their capital tied up in just one or two projects at a time. So any delay can easily bring their business to a halt. I think as we look to boost supply post-COVID, it will be more important than ever that we support SME builders, given their significance in the regional property markets and their ability to stimulate economies across the country. And I'll touch on some of the policies being consulted on to support this sector shortly. Just briefly on the land market. So the lockdown unsurprisingly slowed transactions of development land significantly, although the market has now picked back up and appears to have returned to near pre-COVID-19 levels. All of the major house builders have now re-entered the market, so there's a strong competition for sites as developers look to make up for the lack of land buying earlier in the year. More locally, among SMEs, the market is generally pretty strong. Where we are bringing new sites to the market, we're seeing good levels of interest. There continues to be good access to finance. Just last month, across the 4 offices, we reported to lenders on more than 10 development sites of varying scales. Our agents are also busy with a number of deals going through at the moment. We should transact on around £5 million worth this month. In terms of values, the lack of supply and buoyant market conditions has helped hold prices. We are aware of some caution being built into some deals, with developers seeking more flexible payment terms over an extended period. But with the strong competition for sites, developers can't always hold out for these more favourable terms. Finally, I'll just touch on some of the recent planning announcements and some reforms that we might expect to see in the months and years ahead. I'm sure that many of you will be aware that in August, the government published their planning white paper, which set out for consultation a number of significant reforms to the current planning system. I'll just mention some of the highlights from that document. So firstly, there is the intention to reimpose top-down housing targets on local authorities with a new standard method based on how many existing homes are in an area, the projected rise in households, and changes in affordability. In terms of what that means for the Southwest, that very much depends on where you are. Some areas such as West Devon, Gloucester, and South Somerset would see their requirements under the revised method fall by between 10 to 15%, whilst other areas such as the Cotswolds, South Hams, and Teignbridge would see their requirements increase by between 100 to 150%. Generally, the revised standard method results in a higher requirement. The government has also indicated that these targets will be binding, although there is little detail on potential sanctions at this stage. Secondly, there is the new zoning approach. So unlike the current regime where local authorities are required to demonstrate a 5-year land supply, they would now need to divide all sites in their area into one of 3 categories, being protected, renewal, or growth. And this is how the councils will decide where the housing they've been told to build by the government will go. Any land designated for growth will benefit from an automatic planning permission, with developers required only to pursue reserved matters planning consents in accordance with locally drawn up design codes. And just whilst I'm on this point and looking ahead, local authorities will need to be reviewing their strategic site allocations, which gives us an opportunity to promote sites for development. So if you have a site which you think might have development potential, then do please come and talk to us. Finally, on the white paper reforms, there's the new infrastructure levy, which would replace the existing community infrastructure levy and Section 106 with a new flat rate levy tied to final development values. We understand that there will be provision for on-site delivery, which can be offset from the final cash liability. But again, we await to see the detail around how this would work in practice. And just lastly, to touch on the separate consultation document that was published alongside the planning white paper titled Changes to the Current Planning System. The document sets out more immediate reforms that the government wishes to enact. This includes detail on the First Homes initiative, an extension of the current permission in principle regime, and also probably most notably outlining an intention to increase the affordable housing unit threshold from 10 to either 40 or 50 in an attempt to enable more SME development in the wake of coronavirus. And this will no doubt be widely welcomed by SME developers and give a short-term boost to housing delivery, although we know that a number of affordable housing providers are very concerned about the impact this will have on affordable housing delivery, with the government acknowledging that this could result in a reduction in the number of affordable homes delivered by up to 20% during the initial 18-month period. On the ground, we are starting to see landowners putting off bringing sites to the market until we get more clarity on the proposals, with one of the consequences of such policy change no doubt being higher land prices for those sites of sub 40 or 50 units. The consultation for both documents closed at the end of October, so now we wait to see the outcome and, crucially, the detail around the implementation. Just before I finish up, let's just take a quick look at the poll responses and see what the consensus is around house prices in the year ahead. So to remind you of the question, in the next 12 months, will average house prices in the Southwest increase, decrease, or stagnate? We've had 148 responses. The majority suggesting that house prices will increase, 53% suggesting house prices will increase, 15% of you suggesting that house prices will decrease, and 30% suggesting that house prices will stagnate. Interesting to see that the consensus is generally pretty positive. I think I share the optimism in the room on this. I think the market fundamentals are pretty strong, and I think if anywhere is going to come out of 2021 in a better position than when they went into it, then really the Southwest has got to stand as good a chance as anywhere, I would say. That's it from me. Thank you for listening. Hopefully it's been insightful. I'll now hand you over to Ollie, who's going to give you an update on the leisure market. Over to you, Ollie.
Hi, thanks. Hi, everyone. Thanks, Steve. Thanks for a great update and some useful insight there. My name's Ollie Steer-Fowler. I'm the head of leisure here at Vickery Holman. I mainly work out of the extra office in agency and general practice teams, and I'm part of our ever-growing leisure team, which covers the whole of the Southwest and offers the full spectrum of services from VH to hotels, pubs, restaurants, holiday park operators, campsite operators, amongst the other property types that we deal with. The main bulk of work that we do here in the leisure team is valuation, agency disposals and business rates work, for which we've dedicated specialists now. So that places us really, we think, at the forefront of the market amongst regional property consultancies. Again, much like Steve just requested, if you could respond to our poll question, which is on your likely holiday, next holiday or trip or short break destination for 2021, that'd be much appreciated, and we can review the answers at the end. I'd just like to take this opportunity very quickly to welcome a new exciting addition to our team this autumn in the form of Mike Easton, who joins VH from one of the national consultancies where he spent a number of years. Mike's got an established background in the hotel and hospitality sector and pub sector especially, in which time he's grown a substantial client base and reputation in the sector, and we're delighted that he's able to transfer that expertise over to us at Vickery Holman. These are exciting times for our team, really. Mike joins myself and Nicola Murrish, who specialises in leisure business rates consultancy, in providing our services across the whole of the Southwest area. We've currently got a strong portfolio, a strong and growing portfolio of pub, hotel and self-catering properties on our books from an agency perspective. So that's from substantial pubs to holiday complexes to hotels. So please do speak to us further should you or your clients be interested in acquiring in the sector. So the coronavirus pandemic, which came really to a head in March 2020, saw the almost total shutdown of leisure businesses across the southwest at perhaps the worst possible time of the year, where normally operators would be preparing for revenue spikes in Easter and then on to the bank holidays in May. Despite the fears that we had in early March, we did see significant support come in, thank goodness, for businesses during 2020 with rates relief, VAT reductions, business interruption bounce back loans, the furlough scheme, most importantly, and interest holidays. So there's been unprecedented support really to the industry, which has secured the medium-term future for quite a large proportion of operators and given many the opportunity to reassess their offer and plan for the years ahead. Once businesses were able to reopen in July, trade across the accommodation sector in particular was very strong, with booking levels and occupancy rates outstripping supply in some areas of the southwest. In late June, self-catering agency Ho Seasons reported a booking taken every 11 seconds at one point. So that gives you all a general indication of the pent-up demand that was within the UK population to take a break once the lockdown subsided. It'll be interesting to see from our poll results in a minute whether this is reflected in lockdown Mark 2 at the end of it, whether the pent-up demand is there or whether you're all happy to hop on a plane. So I'm sure that you've all seen at least one news article highlighting the growth in staycations in the UK in the last few years, and the UK's propensity for a holiday spent in this country has been aided by the rapidly improving quality of offerings across the accommodation sector. There's the sheer choice on offer and the perceived level of value seen by most compared to holidaying abroad. The pandemic we've seen this year has only really served to further accelerate this growing trend and provided further demand for operators to absorb moving into 2021. It's this demand that's fueling the self-catering, hotel and holiday park sectors in particular. And the southwest region, that is Cornwall, Devon, Somerset, Bristol and Dorset, were responsible for 25% of all holiday trips taken in the UK last year, and over 27% of the total spend. So really, we're still at the very sharp end of a visitor attraction area. And the continued popularity of this area as a destination for short breaks and holidays looks set to underpin these markets for the types of accommodation-based property businesses next year. So hotels, pubs and restaurants. Many hoteliers jumped back in lockdown to support the NHS and some local authority housing during the spring onset of COVID-19. The end of lockdown Mark 1 brought about a high demand throughout the southwest and a very, very busy end to the season, curtailed only really by the lockdown Mark 2, which has just finished. The coaching market felt the brunt of customer sentiment, with a mix of nervousness from the customer base and latterly the 3-tier system, meaning customers in tier 3 were unable to travel to tier 1, which meant venues in this tier lost their customer base during this period and ultimately were left with pretty much no support. Occupancy rates pushed up and hotel restaurants benefited from the government's Eat Out to Help Out scheme, although discounting at that point came with the initiative, came at a time when the southwest was already really, really busy. So in any event, many operators struggled to satisfy customer expectations and were almost too busy. Lockdown 2 and the continuing position with COVID-19 has created low booking rates and taken the Christmas market away for many. Ultimately, as of right now, the extension to the furlough scheme has resulted in many operators choosing to close for the remainder of 2020 and then target late January, maybe into February half term 2021 to reopen. When operators will hope there's plainer sailing to be had, really. While we're talking about hotels, just as a slight aside, I'd like to do a shameless plug for our Leisure Series webinar, which this month is focusing on the hotel and hospitality sector with myself and Mike, being joined by Tom Roach from Francis Clark and Mark Godfrey, the owner of Deer Park, to discuss market conditions, the impact of the pandemic and occupancy. That is on Tuesday next week at 10 a.m. So contact me if you'd like to get involved with that. It would be great to see some of you who could join us. So as with hotels, significant government assistance helped major employers in the pub and restaurant sector. although as time goes on, it appears many have continued to make redundancies as they assess their operational efficiencies, and the job market sees fewer roles available. The wet-led pub market in particular, particularly in city centres, has been hard hit, along with the late-night leisure and market, and this looks set to continue into the early part of 2021 with the new tier system in place. Despite the Eat Out to Help Out initiative, the casual dining market has seen a number of well-known brands go through high-profile CVAs, and the general dumping of unwanted sites back onto the open market at rents which are pretty much unachievable in the current market. No doubt this will accelerate the shrinking of the high street and retail that has been growing with changing consumer demands, as Alan covered pretty comprehensively earlier. Operators in the food-led pub market have made cost savings with landlord support, and with landlord support, the lease and tenanted model appears to have held up until now, although Q1 2021 will be pretty telling for this. So the market for the sale and purchase of self-catering complexes and holiday parks, campsites has remained really strong throughout even the 3 months of lockdown Mark 1, and has continued throughout the summer. Agents in this sector are proving to be really, really busy. There is continued interest from corporate funds, overseas investment at the larger scale of the parks market, over parks with over 100 plus pitches, particularly with the market shift towards a majority of pitches on sites being sold off on shorter term siting agreements of 15 years or so, which provide a steady income per pitch for an investor or operator. Holiday parks at present are viewed as a robust investment asset in the alternative sector, with relatively secure long-term income from a variety of different streams on a single park asset. So you might have income from pitch fees, income from your facility buildings and food and beverage, and also from your holiday lettings as well, providing you with a pretty good coverage there. At a smaller scale, achieved prices have remained strong as new entrants and lifestyle operators have looked to capitalise on the boom in staycation holidays, as well as a sector with a positive growth forecast, really. Transaction levels have decreased compared to 2019, but that's completely to be expected this year. It's been, with all of certain uncertainties and barriers brought about by the pandemic this year, but it definitely still remains a seller's market. The appetite for purchases is still very much there. In terms of prices being achieved, at present these have reached, well, in some cases, unprecedented levels for prime assets in the last 12 months. My thoughts on this are perhaps due to the considerable competition in the market to secure the best locations, twin with very, very low supply levels. From our work undertaken in the sector, from a valuation standpoint, values for trading holiday park assets have consistently ranged from between 10 and 12 times years purchase on adjusted net profit levels, with exceptional properties perhaps touching 14 times years purchase. Some parks have transacted at the very top end of the market as high as 18. But this is very, very dependent on unit mix, quality of accommodation, most important, location. Location is everything. So just to finish up, we traditionally like to make a few predictions for the coming year. This year's no different. So our hotels, pub and restaurants, courtesy of myself and Mike, medium long-term forecast is looking to be much more positive now, I think. Short term will be very interesting, especially with what's gone on as we've come out of lockdown Mark 2. The hotel public house prices are expected to slip but rally as the year progresses through 2021, we think. Bank lending will still be a major factor in this sector and presents opportunities for alternative funding sources. Operators are optimistic that we've been speaking to for 2021 and into 2022, obviously to take advantage of the staycation boom, and keen to restart in earnest from early next year. Available sites are expected to remain low due to the government-led support, although it will be very, very interesting to see what happens in April when the second furlough scheme ends. The Southwest hospitality sector is of growing interest to both domestic and foreign capital. Holiday parks and self-catering is going to be a positive outlook again for 2021. It's been a number of good back-to-back seasons before this year, so we think that will re-emerge in 2021. Pre-bookings and expected occupancy levels are strong from the operators we've been speaking to, despite lockdown 2. due to the staycation boost, again, as I mentioned earlier. There will be a continued shortage of supply as a result of interest from new entrants and overseas investment as people look to take advantage of what people would assume would be 2 good years coming up at least. Lenders retain a slightly more positive, from lenders that we've been speaking to, slightly more positive view on backing the park sector than perhaps some other of the accommodation sectors that we spoke about earlier. I would expect to see further growth in the luxury lodge park market. We've seen a number of specialist developers who are acquiring land either themselves or on behalf of clients to take advantage of this high return on investment model in the last 18 months. So we would see that set to continue. There's a slide just detailing a couple of events that we've got coming up. That's it from me. So thanks for listening, everyone. And I hope this is pretty useful for those of you who are interested in this sector. Feel free to contact me or my colleagues in the team following this presentation. We'll be happy to discuss your queries. Let's just very quickly go over our poll results. Mixed bag, as I would probably expect. It would be very interesting to find out further down the line. It's a shame that we can only do one poll, really, to find out whether that would have changed, people's sentiment would have changed, and that would have looked completely different at the end of last year, whether the abroad figure there of 47% would have been much, much higher looking towards 2021. And see if that's shifted back. But it pretty much a mixed bag, which is what we would expect to see when you're looking, at the whole of next year. It will be very interesting to see the early part of next year how much of an impact restrictions have on people looking to holiday abroad. But thank you to the 146 of you who did take part in that. Thanks very much. So that's now I'd like to hand over to my colleague Rebecca Cook, who's going to provide an update on the world of business rates and her team's thoughts. Over to you, Rebecca.
Hi everyone, my name is Rebecca Cook. I'm a chartered surveyor and head of business rates consultancy based in our Treloar office. I thought I would use this time to briefly summarise some of the recent changes in the world of business rates and update you on what we've been doing to help our clients mitigate their liability. Before I start, we've added a poll question. If you occupy a commercial property, have you had your business rates checked for the 2017 rating list? I look forward to seeing your answers at the end of the talk. So it's fair to say a lot has happened over the last 9 months, with the business rate system being used extensively to deliver a range of financial assistance measures to businesses during the COVID-19 crisis. Amongst the measures put in place was what the government referred to as its expanded retail, leisure and hospitality relief scheme, otherwise known as the business rates holiday. The scheme provides 100% discount to businesses in the retail, leisure and hospitality sectors for the 2020 financial year, so no rates payable until April 2021. This was expanded to include nurseries. The government issued extensive guidance to local authorities detailing the type of commercial properties that would be eligible for the relief, although local authorities were given discretion to decide whether specific uses fell within the broader categories listed within the guidance. This, of course, brought about some problems with disagreements between businesses and local authorities over qualification for the holiday, and sadly, no grounds for appeal. We give credit to the government for supporting a significant proportion of businesses, and arguably those worst affected, at what is understood to have been at a cost of around £10 billion. But what about those businesses who were impacted as they supplied to those sectors? And then, of course, there are those of us who were encouraged to work from home. I'm sure many of our offices were closed during the lockdown period, whilst we still paid and continue to pay our business rates liability. As at today's date, business rates for the retail, leisure and hospitality sectors will be due in April 2021. Despite calls from senior politicians to extend the relief, the government has yet to address this. We anticipate any announcements on the extension of the scheme, be that for a specific period or through a phased reintroduction, will be subject to the outcome of the recent lockdown. Now, the 2017 business rates revaluation, or the current rating list, was originally intended to last 5 years, as had all lists since 1990, except for the 2015 revaluation, which was postponed to 2017. This was, however, intended to be brought forward to 2021, with the government then intending to hold them 3 yearly, so rates bills would be more responsive to changes in the property rental market. However, the 21 revaluation did not receive royal assent, and then COVID came about, postponing the 21 revaluation to the default position of 2022. We are now looking at a revaluation date of 2023 based on rental values as of the 1st of April 2021. At the time of the announcement, it was hoped the pandemic would be well and truly behind us, presenting a clearer picture of its impact and any implications upon commercial property and market rental values. As the revaluation date fast approaches, we must question whether there will be sufficient quality market transactional evidence for the Valuation Office Agency to base its revaluations on. In the meantime, the 2017 rating list is based on rental values as of 2015. If we think back over the last 5 years, we've had the Brexit vote, 2 general elections, and more recently, COVID, meaning rateable values are significantly out of touch with the current market. If the government does not extend the relief available, businesses will be unfairly impacted. We continue to act on behalf of owners and occupiers, checking and challenging business rates assessments and advising on available relief schemes. The business rates check challenge appeal system continues to be a burdensome and lengthy process with extensive registration requirements, putting the onus on the ratepayer to demonstrate their assessment is incorrect or excessive. Check Challenge Appeal, or CCA, is a 3-stage process that must be undertaken in sequence. This can mean significant delays for ratepayers if they need to challenge an assessment, as they will first need to submit a check to confirm the information held by the VOA is correct. This can take up to 12 months, although in our experience generally takes between 3 and 4, or quicker if you are simply submitting a check to move on to the next stage. A challenge can take up to 18 months, meaning the process can take up to a total of 2.5 years, while during this time, the ratepayer will be liable for the cost of the business rates based on the current assessment. To us, this seems incredibly unfair. To give an example, we have recently acted on the behalf of a veterinary practice in South Devon. It was evident on inspection and from our conversations with the client, the VOA had not physically inspected the property and had based the assessment on scaled floor plans from the planning portal. The assessment included a storeroom, a dog training facility, and 2 staff apartments. The reality of this was a plant room, a grass enclosure, and 2 independent self-contained apartments, all of which should never have been included within the assessment, with the apartments being assessed for council tax purposes. Our client attempted to contact the VOA to have the property reassessed and invited them to inspect the property. She was directed to CCA, at which stage she felt she had to appoint us to act on her behalf due to the sheer complexity of the system. I'm pleased to report we have been successful in removing the storeroom and external enclosure, however, remain in discussion with the VOA over the apartments. I would add the VOA has still not inspected the property. This is, of course, a great outcome for our client, who has been rebated for the over-assessed liability. However, they will continue to pay the business rates liability on the apartments until these are removed and assessed for council tax purposes. I hope this has provided you with an overview of some of the changes in the world of business rates over the last couple of months and an insight into the type of work we are doing on behalf of our clients and the importance of seeking professional advice now more than ever. Before I go, let's take a look at the answers to the poll. We asked you, if you occupy a commercial property, have you had your business rates checked for the 2017 rating list? And pretty much a mixed bag. So for those of you that have answered no, I hope the talk has highlighted the importance of having your business rates assessment checked, and happy to talk to those of you about it in further detail. That's it from me. I'll now hand you back to Mark Pellow, and thank you all for your time.
Thank you, Rebecca, and all our speakers today. I would like to say at the outset of just this question and answer session that I apologise for one or two. I know I've had some IT issues from the chat, particularly on the sound, and I think refreshing it seems to solve some of those problems. Anyone who knows me too well will say often my biggest dislike in the world is IT, particularly when it goes wrong. But the good news is, of course, there is a YouTube channel that we are going to post to, and also we will be putting out some handouts at the end of this presentation, which are available for you to download. And in addition, we probably have a link to our website. So hopefully you'll be able to catch up with all the bits and pieces later. So thank you for that and your patience for those who certainly had some problems. I see the attendees basically stayed up. The numbers stayed up throughout the talk, so I gather most people were able to hear most of it at least. So I hope you've got what you needed. Right, let me have a look at the questions, if I may, that have come up. Firstly, I think I'll invite Alan to come on screen with me. Alan, if you could join me.
I'm here, Mark.
Right, question for you, I think. Has the increase in the viewings this year been focused on certain types of properties, i.e. smaller, is the question that's being asked?
Yeah, okay, that's a good question. I think it's been from more independent occupiers and buyers and tenants, and so I think that's the thing. I think the property sizes is less of a factor. It's actually just the people that we've mainly been treating with, if I think about it, are probably those that are more in control of their own immediate destiny, whereas corporates have been putting their horns in, waiting, adopting a bit of a wait and see sort of attitude. So we've had, there's exceptions to that, trade counter occupiers in particular, and maybe the odd sort of opportunistic larger retailer maybe. There's been the odd bit of government and council kind of interest around for different things, but I think that largely it's been people who've been in control of what they're doing and have formed their own opinion on what their future is going to look like and where they're going, and have used this last few months almost as a period to get out there and start working that future out. So yeah, I think it's the local and regional independent operators has been the theme more than anything else, I think.
And Alan, thank you, if you could kindly stay with us, because there's a second question for you, I see. You've mentioned substantial downward pressure on retail rents, not too surprisingly. But what letting incentives and lease term flexibilities are tenants now seeking? Yeah. And I think sort of related to that, what's our advice to landlords of retail property? I think is a sort of part of that, really. Yeah,
I mean, I think the retail, as with some of the other things we've talked about, it's not all about the last 9 months and the COVID thing. The pressure on, and it's probably not been quite captured in the very brief bullet points in our slides, really. But retail's been very difficult for a very long time. And that pressure on rents and other terms has been something that's been a factor for, in many locations, a long time. I suppose what there has been previously is there's been exceptions to that in some locations that are particularly sought after. There may still have been competitive interest, and so incentives and lease terms and so on have remained fairly strong from a landlord's point of view. But I think that's going to weaken a bit as the overall tone of retailing kind of weakens a bit as well. So. But the idea of shorter leases, rentals starting at a lower level and phasing upwards over a term of a few years, even in the primest of locations, certainly in the southwest, it would seem that I'm coming across anyway. People are talking sort of 6 years, break at 3, 5-year leases, that sort of thing as a maximum commitment. Whereas probably pre-COVID, you'd have hoped perhaps for at least 10 years with a break at 5, maybe something like that. So on the incentive front, it's still about the classics like rent-free and as I say, a low starting rent phasing upwards to something that's a bit more palatable for the landlords after a period of years. We're not seeing new occupiers quite yet coming forward with turnover rents linked to their proposals. Where we're seeing turnover rents is where we're acting for landlords who've got tenants that aren't disappearing, but just trying to re-gear themselves to hang on in there, and that's where we're seeing like a base rental within a turnover based top up seems to be what's coming out of some negotiations now.
Okay, thank you, Alan. I'm conscious of time, but there was another late question for you on yields and how they're looking at the moment between retail, offices, industrial. I don't know if there's only a very brief comment you can make on that. Really?
Yeah, I mean, specifically, we haven't got into the investment market because that's a whole another thing to talk about, which I was conscious that we didn't talk about. And I said right at the start, there's almost a webinar in every sector at the moment to have, and that would be a conversation to have. I mean, I think what we are seeing, without getting too specific, is it's industrial is the leader of the pack in terms of attractiveness to investors, really. So I guess by that token, then if we got into some analysis of it, industrial yields, well let trade counters, or well let to distribution companies, that sort of thing, they're the really blue chip things at the moment. Whereas other stuff is going to, has moved outwards, will move outwards further as investors don't quite, see the same attractiveness in those sort of things. Though once they get out to a certain level, there's going to be opportunities there again, because you're going to be starting to buy stuff at a decent level, which if it's got some angles or is well located, or you believe in the location, or some other mix of factors, it'll level out somewhere.
Thank you, Alan. I'll quickly invite, I think, Steve up next. If you can come and join me, Steve. Got a couple of questions for you.
Hi, Mark.
Hi, right. Stephen, a question from our audience today. What are your views on build costs and labour supply for the next 12 months?
I think the biggest difficulty next year will probably be obtaining materials, and the potential for material prices to increase as a result of lack of supply, in the context of Brexit. And this does have the potential to threaten, the viability of some projects, especially if we start to see prices retract. In terms of labour supply, I mean, the construction sector is quite heavily reliant on EU workers. So again, Brexit coupled with the end of free movement, certainly threatens to intensify, the sort of skills shortages that we already face. So I think there needs to be continued investment in sort of apprenticeship schemes and the like, to continue to encourage young people into the sector, I think.
Okay, thank you. There's also a question of the principal residence restriction having impact on local housing markets. Have we got anything at this stage?
Yeah, I mean, I remember commenting on this for the local press in Cornwall back in 2016 when it was first announced that the restriction was going to be introduced in St Ives, and I shared the same view as many others back then in suggesting that the policy had the potential to have the adverse effect and actually end up reducing supply and pushing up prices. And 4 years on, and with enough data now that we can actually start to analyse the impact, we can see that there is less new development taking place in the town, as developers have looked to alternative markets, and whilst house prices of new builds, which makes up just a tiny proportion of the housing stock, has fallen, I think it's about 10 to 15% as of the end of 2019, I believe. But at the same time, house prices for existing homes has risen by about 10%, as demand has clearly switched from new builds to existing homes, which aren't restricted under the policy. So I don't think the policy has been a massive success by any means. I would rather see a sort of simple value tax on second homes, with that money then staying in the local community. But I think there's definitely a debate to be had on this, and around how we protect, the integrity of local communities whilst, also ensuring that, truly affordable homes remain available for local people. So, always happy to hear other people's views on this. So, do please get in touch.
I think given the time, there's a couple other questions, but we will try to get back to those people. Some questions for Steve in particular. Can I perhaps invite Ollie to join me? Thank you, Steve.
Cheers.
Yeah, hi, Mark.
Hi, Ollie. Questions around the lines of which leisure sector is it that we think has been most affected by the tier system being put in place for the foreseeable future? Is there a difference between the leisure sectors and how they've been hit and will be hit by this?
Well, as I say in my talk, I think that not the majority, but a significant proportion of parks and hotels have closed now and won't be coming back into operation until early part of next year. So probably over the Christmas period, market's going to be pubs, especially the wet-led pub sector. I think I read the other day that UK hospitality has said that it found that a quarter of publicans have said that they would be able to turn a profit if they were in a tier 1 scenario, a la what Cornwall is in now, and that's compared to 75% who said that they'd be operating at a loss if they were in tier 2 or above. So really, it'll be interesting to see if there's a clear disparity in businesses in Cornwall for the next few months, especially over such a key period such as Christmas.
Okay, thank you, Ollie. I'll let you go. Thank you for that. Yeah. And then just one for Rebecca. Would you like to quickly join me? I think we've got time for one more question. Oh, Rebecca, hi. A question about rateable values and whether we think they're going to fall in the next revaluation for retail property.
Okay, interesting question.
I know you may have partly touched upon that.
Yes, so the 23 revaluation will be based on rental values as of the 1st of April 2021, whereas current rateable values are based on rents as of the 1st of April 2015. I think Alan has well and truly covered our thoughts on the retail market over sort of the recent months. So yes, I think it's fair to say that we will expect falls in rateable values, reflecting market conditions as of today's date, which will be what the Valuation Office Agency is basing their opinions on. So yes, I think it's fair to say that we should, generally speaking, see a fall in retail rentable values. Yeah.
Well, thank you, Rebecca. Right, I think that just about wraps it up. Thank you to all those who've attended. I apologise again for one or two who've lost the sound at certain points, but I think the majority stayed with us. So I'm assuming that the majority of you have been able to hear what we've had to say and ask your questions and join in. So appreciate that very much. We will be doing another one in the new year. Meanwhile, any further questions do come back to us individually within our 4 offices in the Southwest. And finally, there are the handouts. You'll see that on the slides come up, available, and also follow us on YouTube. And finally, just want to say goodbye to you all. Stay safe, and I hope you do have a good Christmas. I don't think it's too early to say that. So thank you and goodbye.